Here are some general tips to consider when investing in stocks. Look for companies with a strong track record of financial performance. One way to evaluate a company's financial performance is to look at its revenue and earnings growth over time. Companies that have a history of steady growth may be more likely to continue that trend in the future. It's important to look at a company's financial statements, including its income statement, balance sheet, and cash flow statement, to get a clear picture of its financial health. Consider investing in companies with a competitive advantage. A competitive advantage can help a company stand out from its peers and maintain its market position over time. This may be due to a strong brand, valuable patents or technology, or a large market share. Companies with a competitive advantage may be more likely to generate consistent revenue and earnings over time. Look for companies with good management. A strong leadership team can help guide a company's strategic vision and make smart decisions to drive growth. When evaluating a company, consider the track record of its management team, including its experience, expertise, and leadership style. Look for companies with a clear vision for the future and a well-defined strategy for achieving their goals. Consider companies that are well-positioned to benefit from long-term trends. Investing in companies that are well-positioned to benefit from long-term trends can be a smart strategy for long-term growth. For example, the growth of e-commerce has created opportunities for companies that specialize in logistics and fulfillment, while the adoption of renewable energy is driving demand for companies in the clean energy industry. Look for companies that are well-positioned to benefit from these trends and have a clear strategy for capitalizing on them. Diversify your investments. Diversification is an important strategy for reducing risk in your investment portfolio. By investing in a range of different companies and sectors, you can spread out your risk and reduce the impact of any single investment on your overall portfolio. Consider investing in a mix of large and small companies, domestic and international stocks, and different sectors, such as technology, healthcare, and consumer goods. Understand the company's valuation. A company's valuation is the price that investors are willing to pay for its stock based on its earnings, assets, and growth prospects. Understanding a company's valuation can help you determine whether its stock is overvalued or undervalued compared to its peers. One common measure of valuation is the price-to-earnings (P/E) ratio, which compares a company's stock price to its earnings per share. Pay attention to the company's dividend policy. Some companies pay out a portion of their earnings as dividends to shareholders. If you're interested in receiving regular income from your investments, you may want to look for companies with a history of paying consistent dividends. However, it's important to remember that a high dividend yield may not always be sustainable, and companies may choose to reduce or suspend their dividend payments in the future. Be aware of market trends and risks. The stock market is influenced by a variety of factors, including economic conditions, geopolitical events, and changes in consumer behavior. Paying attention to market trends and risks can help you make more informed investment decisions. For example, you may want to be cautious about investing in companies that are heavily reliant on a single customer or industry, as this can create additional risks. Consider investing in index funds or exchange-traded funds, ETFs. If you're not comfortable picking individual stocks, you may want to consider investing in index funds or ETFs. These are investment vehicles that track a particular index, such as the S&P 500, and offer exposure to a broad range of companies and sectors. They can be a convenient and cost-effective way to diversify your investments and minimize your risk. Have a long-term investment strategy. The stock market can be volatile in the short term, and it's important to have a long-term investment strategy to help you weather market ups and downs. Consider setting investment goals for the long term, such as retirement, and make investment decisions that align with those goals. Avoid making impulsive decisions based on short-term market fluctuations, and stick to your investment plan over time.